All right, thank you very much. Thank you very much for the invitation, and generally to the organizers, I guess including myself, for this great conference. To discuss this interesting paper that I learned a lot from. I think it is a very interesting paper, and I'm going to say that it is instructive in some ways that I didn't expect. It made me think. But let me just, to some extent, many of my thoughts coincide with Paulina's discussion. And I'm going to take advantage also of the very good presentation by Julien, because I think that he presented very well the technical details. But let me just summarize quickly what I see are the main questions that this paper is supposed to be, is trying to do. I mean, the motivation is that the literature on macroprudential policy and more generally, I guess, on financial regulation or taxation has abstracted from imperfect enforcement. That's actually in the first page of the paper. So the paper is trying to propose a general framework, a way to think about the issues that Julien emphasized. How does macroprudential policy work if there are leakages, right? In particular, does macroprudential policy remain effective or desirable, and what is the optimal policy when there are leakages? And here I have emphasized the for a reason, as you're going to see. But in any case, the strategy is quite simple. Actually, in some sense, it's disarmingly straightforward. I mean, take a model of recent vintage, like Bianchi Mendoza type, small bank economy with a number of features that people in this room are quite familiar with. Endowments of tradables and non-tradables. There are binding constraints that are borrowing constraints that are occasionally binding, right? And those constraints depend on the real exchange rate, on the tradables value of current income, in the terminology of Diego Perez's paper in the morning. And all of these elements we know give rise to externalities that are pecuniary. They work through the real exchange rate, okay? And those externalities may justify taxes, right? That or subsidies, for that matter. There has been some debate about that on external borrowing, right? So this is actually a model that we have become quite familiar with. And the main twist, of course, is that in this model, essentially the assumption is there's a subset of agents that pay taxes, and there's another group of agents that are outside the taxing system, right? Otherwise, the model is the same as before. But that modeling choice actually has a lot of consequences to it. Some are intuitive and instructive. Some are more questionable, I'm going to argue, right? So the main implication, Julien did a very good job, I think, in highlighting what I think is the main feature of this model, right? Which is, to me, the substitutability part, right? And that's the question, the issue that Paulina raised at the end. Well, what was the intuition and whether it would survive? I guess more general setups. But the idea is that, at least departing from a no taxation benchmark, if regulated agents reduce the borrowing because, we force them to borrow less, then unregulated ones have an incentive to increase their own borrowing, right? To me, the intuition is quite clear in the context of this model, right? So if regulated agents reduce the borrowing today, tomorrow there is less debt in the economy as a whole, right? So in general, in this model, the real exchange rate is going to become stronger, right? In more states of nature, right? And because of the pecuniary externality that's going to relax future borrowing constraints, that helps the situation with unregulated agents, or unregulated agents are going to consume more, right, in the future, and because of that reason, they are going to also try to consume more today. So they're going to borrow more today. I believe that's the intuition, and it's quite intuitive to me. And I think that because it's intuitive, then it's likely to survive generalizations to the model, right? But no, that once you have understood that particular intuition, then the other aspects of the model actually come out quite naturally. For example, the fact that there's substitutability in a way means that taxation becomes less effective in curbing borrowing, right? Because the idea is, well, okay, you want to like reduce, say, the borrowing, say, by regulated agents, you impose taxes on them, right? But then unregulated agents are going to borrow more, so the taxes that you would have to impose have to be higher than they would have been otherwise. And even in this situation, however, macroprudential policy remains useful in the sense, there are at least two senses in which this is the case. One is that a small macroprudential policy tax is still welfare improving, right? And the intuition here is essentially the same intuition as the small optimal tariff argument, right? The macroprudential policy tax, when there are pecuniary externalities, that tax has a first order effect, right, on the welfare of everybody, right? But the counteracting actions of the unregulated sector are only of second order, right? Beyond that, it becomes more of an empirical question, right? Now, in order to do that, the paper looks at what a utilitarian planner would do, right? And then it says, well, that planner would actually end up taxing more than in the absence of leakages, right? This is actually a notable aspect of the discussion, right? And in fact, the paper says more. It says, while leakages actually lead to a situation on average, which is very similar to the situation without leakages, when there is optimal macroprudential policy. The welfare gains are spread unevenly, right? Quite unevenly, in fact. Julien presented this figure, but I wanted to highlight that because when you look, for example, at the case, for example, where half of the economy is unregulated, then essentially the regulated agents suffer a lot, right? Most of the gains from macroprudential policy actually are go to unregulated agents, right? And in fact, this is also like highlighted in the experiment that the paper does in thinking about, for example, what happens around, say, a typical crisis. In a typical crisis, the idea is, well, there's a sequence of negative shocks to endowments, right? So agents borrow. Presumably, agents would, if there was no leakage, then agents would borrow up to a point where they can not borrow that much, so they have to like deleverage all of a sudden, right? So to prevent that, in this graph, the green dashed lines are the case in which there are no leakages, and the purple lines are the case where there is leakages of 50%, right? So you can see that the optimal policy actually asks the regulated agents to reduce their borrowing prior to the crisis, right? Substantially. You're talking about like, here it goes from 0.93 to 0.85, right? Whereas unregulated agents, in fact, increase their debt in the same period, right? And when you compare, for example, what this means for taxation, right? It means that, for example, the taxes that we are imposing on regulated agents is greater than if there have been no leakages. Okay. So in some sense, the results are all intuitive to me. The exercise is quite nicely done in my way, and I think that this is something that I would like to keep in mind when I think about policy. But on the other hand, I think that as Paulina, then it made me think about some more basic issues that may be important for the discussion, especially if we are going to try to use this kind of paper to provide advice to policymakers. For example, one question is whether this model captures, in fact, the main constraints that imperfect policy enforcement places on macroprudential policy, right? And then secondly, a more general question, well, what do we mean with optimal? Or in this case, for whom is this optimal policy optimal, right? I mean, this is actually not a trivial question. Let me start with the aspect of the, say, the paper's architecture, if you want, that simplifies the analysis a lot, but on the other hand, as Paulina's discussion highlighted, may be quite debatable, which is, in the model, there's a subset of agents that is permanently outside the reach of the taxing authorities, right? So is this what we have in mind when we think about imperfect enforcement and leakages, and why regulators are worried about it?
Roberto, you have 5 minutes.
Okay. Yeah, maybe not. I mean, in fact, Paulina talked a lot about that this model is a model about the informal sector, right? And I thought about the same thing. I mean, to some extent, this is a model that would apply to, say, the informal economy or the illegal economy, right? Where there is like some group of agents that, for some reason, they are outside the reach of the taxing authority, and permanently, right? But now, when you think about it, then the next thought is, well, these people actually are informal and illegal people. I mean, they do not have the same access to international financial markets as, say, the formal or legal groups, right? I mean, in fact, there are huge differences, right? However, it is crucial for the paper's results, right, that other than the difference of being able subject to taxation or not, all agents are the same, right? So now this actually brings the question: well, is this kind of a specification capturing the main leakages that financial regulators are concerned with in practice, right? I'm going to argue, well, in general, we always have in mind a different alternative, right? Financial market participants sometimes switch to different financial engineering schemes, switch investments, or just evade taxes, but at the cost of a punishment, right? So there's always like a trade-off, right? That of cost and benefit of regulation that regulators keep in mind, and there is good examples of this kind of discussion, right? I mean, in Chile, for example, there was a discussion about the impact of, say, taxing short-term capital flows, and the question whether it only changed the composition of capital flows, right? Julien, in his introduction, said, well, shadow banking. Well, this is a good example as well, right? I mean, bank regulation has essentially been one of the reasons why, for example, prior to the global financial crisis of 1997 to 2007-9, there was an emergence of a huge shadow banking sector, presumably. And also, a third example that is, for example, I took this from a paper by Peter Garber that was very important in my view, but has been sort of ignored in the literature, which he talks about the impact of derivatives and capital flows. And he says, for example, derivatives can be used to evade risk control or prudential regulation, thereby undermining the usefulness of balance payments capital account categories. So there's a good literature on the kinds of financial evasion of financial regulations that I think that speaks more to the concerns of financial regulation authorities.
2 minutes.
By the way,
Roberto.
2 minutes. Yeah.
2 minutes. Yeah.
I agree with the importance of making endogenous the fraction of unregulated agents. The paper argues that it could be made endogenous, assuming that at the beginning of time, say, people abide by regulations or not, by choosing, by paying a cost, right? This would be a step in the right direction. I'm going to say, however, that the way that the paper is proceeding does not provide an answer to that question, because the paper says, well, for any exogenous gamma, I can choose a choice, I can choose the distribution of circumvention costs so that gamma is actually optimal, right? But that's not an answer to me. I mean, what is endogenous is that distribution, it's not gamma, right? So, what we really want to know, in some sense, is, whether, the possibility of comply or not with regulation places constraints on the options of macroprudential policy regulators. I mean, that's actually something that I would take seriously. Finally, the question about socially optimal. The social planner maximizes a population-weighted sum of the utilities of regulated agents. So all agents in the planning solution are taken to be the same, but agents are not the same, right? In this model, there are agents that pay taxes and agents that do not pay taxes, right? So it's very hard to come up with a justification to treat these agents equally, right? I mean, and this is important because, you know, the optimal solution depends on what you assume about the social welfare function, right? In fact, you know, I might argue that, you know, a suggestion would be you might want to, I mean, let me go back. In fact, the optimal solution seems to punish regulated agents to compensate for the behavior of unregulated agents, right? This is something that leaves me quite uncomfortable, right? I think at the least you might want to ask, well, what would happen if if the social welfare function gave some priority to regulated agents, right? For example, this comes to, you know, from the observation that, you know, it's very hard. I would be very uncomfortable to actually go to a regulator, the Central Bank of Chile, say administrators, and say, look, you know, you have to increase taxes on people that are paying taxes because there are some other people that are not paying taxes, right? And we want to help them, right? I mean, what kind of social welfare function are you assuming that the policymakers actually internalize? I mean, it's not so clear. I mean, the main issue, however, at the end is that in general, and this is a more general issue than your paper, is that the ethical basis for the social welfare function that we assume in the paper is quite shaky, right? And this is a critique of all of us in general. You may want to ask, well, you know, we may want to ask what is the actual social welfare function that policymakers maximize, but then you would have to ask, well, what is the political mechanism that might result in the kind of mandate for the government in your paper, right? That would tell the government, look, you know, if there seems to have be a run of bad shocks in the economy, then you're going to impose taxes on the good people on the economy because you want to help the bad people in the economy, right? It's hard to imagine that you will come up with a political mechanism that will actually give you that kind of social welfare function, right? This is one reason, of course, why economists want prefer to focus on finding Pareto improvements, right, and to look at optimal solutions. Well,
Right.
I'm done.
Very good.
Thank you very much.
Thanks a lot, Roberto. So, Julian, would you like to take maybe 2 or 3 minutes to respond? So we can catch up and have more discussion. And if there is not a lot of questions, maybe you can come back and you can answer.
That sounds good. Yeah, no, absolutely. So first, thanks a lot to both Paulina and Roberto. I think these were both great discussions, lots of very, very useful points. Yeah, so I'll try to be brief and maybe try to like also address some of the points together because several points sort of were similar. So maybe like actually like a broad issue that you seem to be a bit like concerned about is like how we're framing the paper, and in particular whether or not we have this informal sector in mind. And so I have to say when we started on this, we didn't really think about the informal sector of the economy, but we try to sort of be a bit more general and think about like any reason why some agents might be able to avoid financial regulation. And so here, I mean, one thing that seems kind of key is what the banner would want to do here is regulate every agent who is exposing the economy to currency mismatch. So if we think that the informal sector doesn't really have access to dollar funding, doesn't have access to outside sources of funding, then this is not like where the planner would want to intervene. So what we have in mind here, like really like the set of agents that through their financial decisions expose the economy to currency mismatch. And so I'm not really sure that the fit between the informal sector as we normally have it in mind and what we call the unregulated sphere in our paper is that tight as you may have perceived it. So that's something I would just point out, but I mean it's well taken. I agree that like we're not sort of modeling the informal sector aspect in a very detailed way. Yeah, on the issue of what's so special about Macropru related to other policies, I mean, like we came from the angle of trying to contrast Macropru with the other sort of standard macro policy, which is monetary policy, and it's sort of well known that monetary policy is very indiscriminatory. You change the interest rate, it applies to everybody. It kind of fits into the interest rate that different people, you know, like mortgage borrowers, like consumer credit, like all these different categories of loan are somehow connected with monetary policy. We felt that with financial regulation, it's really dependent on how you specify the rules. You know, if you have capital controls, how, you know, on what assets the controls are imposed, on what assets they're not. So we had this sort of sense that the issue of imperfect enforcement was especially like kind of concerning for this Macropru or like capital control type of tools. But with respect to fiscal policy, I agree that it's a more general point. Yeah, I'll try to like select some of the points because I won't be able to go through all of them. But maybe we can actually discuss bilaterally some of the more minor concerns. So regarding the 3-period model, yeah. So why do we have consumption of tradables only at date 1? It doesn't really matter. So we could absolutely add non-tradable consumption as well. It wouldn't interfere with the results. Maybe more generally, the reason why we're having this analytical model is not to make quantitative statement or to you know, actually like draw lessons immediately. It's more like to inform our understanding of how the infinite horizon quantitative model works. So like in general, we tend to think that you know, complicated models are useful when they can help us put numbers on things. But then in terms of like seeing through what mechanisms are operating, they may not be the best ones. And so that's why we're using the 3-period model as a tool. But I wouldn't emphasize too much the kind of results we're getting there. Like one thing you guys pointed out, though, that seemed to be pretty key is this substitutability of choices or of borrowing levels between the two spheres. And here, I mean, I want to say that the model doesn't predict that the flows of credit in the two sectors should be negatively correlated, right? There are many things which in a richer model would make these flows move together. For example, if we had kappa shocks, that would be one reason why they would be moving together, like this financial shock that we heard about this morning. If you had productivity shocks, same thing. If you had preference shocks, same thing. We abstract from all these things, and the only sense in which BU and BR move in different directions is when we compare that to what would happen in an unregulated equilibrium, which is kind of an abstract comparison, because in reality we don't really make this comparison. We're like just looking at the flows, and so I wouldn't necessarily like read the model as predicting that these two things move in different directions. Now, with respect to what assumptions we need for that, I think it's just homotheticity of preferences. So it's actually fairly general. And here the notion is just that, yeah. So I mean, there are different mechanisms going on. One of them, like really the key is that, you know, like when you're richer, you want to consume more. Okay. So you know, both goods are normal, and so like the leakage effect operates through this channel. So I don't think it's something that's too fragile. Then maybe like I guess one big thing that came up too, and then I guess we'll have a chance to talk about more details in bilateral meetings maybe, is this issue of endogenizing the gamma. So I mean, we understand that this is serious, and that ideally a model should have you know, this embedded into the analysis, and we, you know, we agree with that in principle. We just need it for the infinite horizon model. We were basically trying to see this as a first step towards taking into account the important issue of imperfect enforcement. And so we thought that as a first step, we'll do that exogenously, especially for the quantitative part. And then, you know, maybe in future research, we can look at endogenizing this gamma. And actually, we thought about it. We haven't really done it, but we've had some ideas for a while, but they're like quite difficult and very different from what we can do with this model. Now it's true that in the analytical model we can go a bit further, and so the critical element here that makes the mechanism that Roberto had in my present or not, meaning that if there is this potential to evade, is the planner going to take this into account in its decision? And that's something that the planner would. So it's only showing up if there is commitment. So if the decision to regulate somehow comes before the decision of evasion, because then things or actually sorry, rather after the decision to evade. So that's something that we talk a little bit about in a footnote, and we could think about developing that more. But that's a critical element here.
Okay. All right.
So I think I'll stop here. Yeah.
Okay. Thank you, Julian. Thank you very much. So I don't have any questions on the floor of the chat, but let me make you a comment following up on both what Paulina and Roberto said, and you replied. I think about this issue of having to think about endogeneity and the social welfare, the endogeneity of the gamma, the social welfare function, and so on. But maybe the approach I would take for this is you guys decided to think about the leakages as a feature of the borrowers. You have these regulated and dysregulated borrowers. I tend to think more it's a feature of the financial industry. It's a feature of the lenders, in the sense that think about a non-financial corporation. You can decide to go and get a huge bank loan, or you can decide to go to an investment bank and do an structured investment product or a structured investment vehicle. Or, same with choices about credit default swaps and collateralized obligations. So to the extent that you start thinking about, say, the shadow banking, which is a good example, as an example of these leakages, I think more that it is a borrower who has the choice to go through these different vehicles. And of course, the regulation that reaches one set of intermediaries is different from others. That's why, banking regulation is one sort. And of course, with the newer regulation, you always try to broaden the scope. But it always seems that the story that the financial industry and the financial regulators tell you is that you try to put the regulation in one place to plug one hole, and the credit goes through another hole. Yeah. And it's not necessarily that it's illegal. It's to the opposite. It's completely legal. It's just that that's the part that remains unregulated. And that's why the progression, particularly in Chile, for example, has been to create these mega powerful regulators that cover all kinds of the financial industry, the insurance companies, the shadow banks, and then someone else pops up. So in Chile, they have this issue with department stores, with Falabella becoming a big lender. So I mean, to the point is, you could do something like that and think that that is an issue of the financial intermediaries. So you have regulations, say, on banks. I think Vincenzo and I tried to do something like that, where we had banks that had the mark-to-market capital requirements, and then a financial industry that could lend outside of that. And then maybe in that case, you can retain a single borrower. So then you don't have to talk about the social welfare function, about what determines gamma. Instead, a scope to think about how should you regulate that segment of the financial industry that you can regulate, taking into account that there is that other segment of the financial industry that you cannot regulate or not regulate to the same extent. And maybe then, okay, the question changes. Why is that? And how do you endogenously determine the share of those two? Fine. But then you can also kind of anchor that more on data and actual observation on the household side.
That's actually a very good point. So the way I would use that it could sort of be embedded into our story that ultimately, like if these intermediaries that you're saying are able to completely evade the regulation, if they have the capacity to expand, their customer base to the entire economy, then it's as if our gamma was one. So there is nobody that can be regulated, because as soon as you put the regulation to somebody, all the credit is going to migrate. So it's instead of intermediating through bank, it's going to intermediate through these other intermediaries that are able to access the whole economy. But if these intermediaries only have an ability to intermediate to half of the economy, then we're kind of back into what we have, where half of the economy is able to get credit at a price that's not affected by the regulation, and the other half, is kind of stuck with the banks, which have to abide by the regulation. So I think there's sort of like a mapping, but I can see that you're
it's a little more tricky because the way we made it whole is there is like a cost Okay, so there's certain things, a certain scale of lending at which the banks operate, and then past a certain cost, and if you cannot lend them because of capital market regulation, then the other guys. So it doesn't, neither side ever really absorbs the entire credit market. Yeah, otherwise it would be like you said, and one guy will take it all, and then same thing.
So yeah, I think that let me say hi to everyone,
go ahead.
and thank Paulina and Roberto for the great discussion. So I like in particular Paulina's point about emphasizing like more general aspects of the optimal policy problem that we study, because when we started the project, this was quite a few years ago, there was really, we didn't find really any analysis of optimal taxation or optimal regulation when you have the kind of leakages that we wanted to study. And so partly for that reason, we think that starting with a model where this exogenous gamma, this exogenous unregulated sector, was a good starting point. And we have in the paper a way to microfound it based on the on some cost of bypassing the regulation. But as Roberto said, you can always go one layer further and say, okay, now I'm going to microfound how these costs basically emerge in general equilibrium. So again, we see this as a starting point, and then again the quantitative analysis also to try to get a sense of the of the orders of magnitudes of how effective is regulation when you have this kind of leakages. So a lot more robustness for sure can be made. And then finally, regarding Roberto's question about the welfare objective, our theoretical analysis applies really for any Pareto weight. So you could put basically 0 weight on the unregulated agents. And for the quantitative analysis, we do take a stance and we put weights according to the population. But I like the example that Roberto gave, which is in some sense you can have some agents, some agents say, okay, we're getting taxed because we're getting more tax because you cannot tax the other set of agents, and that can actually be welfare improving, and that's the surprising part. It may be even for their own sake that you tax them more.
Okay, very good. So we should wrap it up here so we